Now, AJ, earlier you mentioned, Fannie, Freddie. So, let's talk about that. So, that falls under agency loans, right? So,
That's
can you
correct.
kind of explain to us what agency loan is and how is it different from, say, a loan from a local bank? Maybe some of the pros and cons.
Mhm. Yeah, for sure. So agencies include Freddie Mac, Fannie Mae, and then FHA HUD as well. And Walker Dunlop is a direct lender for those three capital sources. So this is something a little bit newer to me. Doing that business direct. When I was MSF Real Estate Capital, I was not what's called a DUS lender, um,
Mm,
and now I am. So when I was doing loans with the agencies at MSF, I was doing them through another DUS lender, through a Walker Dunlop or someone similar that's a DUS lender. So now I'm doing that business direct with Freddie, Fannie, and HUD, which is great, and it's really expanded my platform. And quite frankly, it's really hard to compete with those three in the multifamily world. They don't lend outside of the multifamily world. They will lend on like mobile home parks or manufactured housing communities, but outside of that and multifamily, they're not providing loans for commercial or office or self-storage or anything like that. So when you're doing a multifamily deal, if it is stabilized, it's typically going, the agencies are typically the most aggressive. Um, the agencies provide a few benefits over a bank. One, they're non-recourse loans. Banks are typically recourse loans. That's a big point, and we started talking about recourse versus non-recourse, and I think everyone can understand that a non-recourse loan is more attractive than a recourse loan. Um, Another big difference is going to be rate. The agencies are super aggressive on rate. We've closed a couple deals sub 3% with the
oh, wow.
agencies this year on multifamily. Um, Banks aren't as competitive in that world. Banks typically offer a 5-year term. They don't like locking up a rate for much longer than 5 years, where the agencies will do a 5, 7, 10, 12, or even longer
Mm,
term, fixed rate. Interest only, the agencies provide interest only, sometimes full term interest only if the leverage is in the right spot. So a little bit lower leverage, around 55 or 60%, you can get interest only for the entire term. But if it's not interest only, it's a 30-year amortization versus banks are oftentimes 25 years. So
right.
that's helpful on your cash flow. Those are probably the main differences
Mm.
between banks and the agencies.
Now, what are some of the downsides? How about like the loan requirements? And how about like some of the terms of the loans? Are there any downsides to agency loans?
It's a little bit harder to maybe get approved if you're beginning in the real estate world. The agencies are providing a non-recourse loan, and like we discussed earlier, they want to see experienced borrowers. So a bank, and especially like a community bank, might be a little bit more willing to go out on a limb with a borrower that's just starting out and doesn't really have the track record that the agencies might look for or might require. Costs to close can be an issue, or not an issue, but can be more expensive than a bank. There's a little bit more red tape and a little bit more due diligence done by the agencies. They're going to require a phase one report and a PCA, property condition assessment report. That's going to be costly. And then who knows what ends up being found in those reports and issues that you might have to work through to get to the closing table. So there's some things like that. But
Okay.
as far as economic terms,
Mhm.
it's really hard to compete.
Right. So great terms as far as like rates and locking up rate for a longer term, longer amortization, but a little bit harder to qualify. Would you say that sums it up?
Yeah, I think that's right.
Okay. Now, how about
I mean, there are other things. For instance, just something that popped up this year where the federal government came out and basically said you can't evict any tenants if you have a loan that's backed by the federal government. So if you
mm,
had a Freddie or Fannie loan during COVID, you weren't able to evict tenants. So things like that, there might be some additional requirements or red tape for taking a loan from that's backed by the government.
got it, got it. Now, talking about agency loans, like, it's my understanding that when somebody buys a house and they take out a mortgage, a lot of times the loan is sold back to the federal government, right, to Fannie or Freddie. So the banks, they just get the loan off of their balance, and then they go out and they can lend again. Like, can you tell us how it's different for commercial lending? Like, do they do the same thing? And if not, how does that affect the borrower?
Yeah, so Freddie and Fannie, and this is the main difference between Freddie and Fannie, is Freddie securitize their loans and they're sold off to the secondary market, and Wells Fargo and banks and big financial institutions are buying pools of these loans, where Fannie loans are serviced by the DUS lender. So if you do a Fannie Mae loan with Walker Dunlop, Walker Dunlop is your servicer, and they're keeping that loan on their balance sheet. There's a little bit of a
Mm,
difference there. In regard to um, differences that a borrower sees, I really don't know that there is much of a difference. It might be a little easier to get to a quick answer if you're doing a Fannie loan, because you're calling up someone that you have a personal relationship with, that is part of the team that's servicing. But I'm not in the servicing world, so I can't really speak super intelligently to this. I don't think that there's a ton of difference that a borrower sees between
got it.
Freddie and Fannie.
Thanks for joining us today. You can find more episodes at therealworkshop.org.